please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Of our businesses. With that, let me start by providing the key highlights. Firstly, we operated in a global macro environment which is probably the best in a decade. We saw strong, synchronous growth across all major economic zones. The global oil and product market, which are of immediate relevance to us, are rebalancing both for crude and products, and inventories are lightening up. We are seeing acceleration in industrial activity around the world, which is driving diesel demand. And after some temporary headwinds in India, we are seeing acceleration in growth in India and strong growth across each of the products that we manufacture. In our petrochemical business, we have completed all the large projects. We reported the highest ever earnings, and we are now among the top 5 producers of petrochemicals globally. In refining, we saw strong product growth. The emphasis there is to move more and more product into the domestic markets, both retail as well as bulk. Our gasification project, with the sustained increase in gas prices that we have seen in the last 2 quarters, is now looking at very robust and strong economics. And I would say with the completion of the petrochemical projects, Jamnagar is the largest integrated refining and petrochemical site in the world and a jewel in Reliance's portfolio. Jio, our large digital services business, has become profitable in the second quarter of its commercial operations and about 3 years ahead of what most industry observers and analysts were expecting. Our retail business continues to grow very strongly. We are showing 100% plus growth in both revenue and earnings over the last year. It is by far the fastest growing retail business in the country, apart from being the largest and most diversified. If we look at our financial performance, record consolidated EBITDA of nearly 20,000 crores. If nothing else, it points to an annual run rate in excess of 80,000 crores for our consolidated businesses. Highest ever consolidated net profit of 9,423 crores, up 25% year on year, and highest ever standalone profit of 8,454 crores, another record. Capex during this quarter was 17,300 crores. And I think the most important statistic in financial results is that unadjusted ROCE expanded by over 400 basis points over the past 12 years as both our digital service and petrochemical projects came to completion. With that, let me point out some highlights of our energy business. 2018, with expected oil demand growth of about 1.3 million barrels in this year, will be the 4th consecutive year of 1.3 to 1.8 million barrels per day oil demand growth globally. Double-digit refining margins. This also is a record for us. For our petrochemical business, as I said, it was a record quarter. EBIT at 5,753 crores, up 73% year on year. Just in 1 year, petrochemical EBIT has grown 73%. It of course came with the highest production volume of 8 million tons in 1 quarter. We have now completed one of the largest petrochemical expansions ever undertaken globally. We have added nearly 60% new capacity in this phase. Jamnagar is now the largest integrated refining petrochemical site in the world. It is also the most complex site in the world, with integration into chemicals at about 32%. It has unmatched feedstock flexibility and availability, and it has probably the most diversified product range of any large such site. We are also fortunate that our capacities in petrochemicals are coming on stream at a time when the global macro environment is positive and looks to remain so for several years. Our polyester chain, in which we have made significant investments in this phase, the margins are now well above their 5-year averages and look to tighten further. And as I said earlier, it's a matter of great pride for us that we are now among the top 5 petrochemical producers globally in terms of volume. Quick highlights on our consumer business. As I said, the retail business has grown exceptionally, very, very strong growth, 116% growth in revenue year on year, and 111% growth in EBIT year on year. We have the largest footprint of any retailer. We now have 3,751 stores in 750 cities and 14.5 million square feet of trading area. Jio, and we will talk more about that, but it is the largest data network in the world, mobile data network in the world, and it is the largest wireless data network in India. With 160 million subscribers and profitability in the second quarter, it has made and will continue to make significant contribution to consolidated Reliance earnings. Let's quickly look at the macro backdrop before I get into talking about each of our businesses. As I said, we expect 2018 to have another year of strong growth in terms of oil product demand, and this is expected to be led by China, India, and US. In 2017, we saw nearly 1.5 million barrels of similar demand, again led by these 3 markets. Oil prices are now at a 3-year high. The OPEC, non-OPEC pact to manage production and extend it to the end of 2018 is leading to the market rebalancing. Inventory levels are slowly declining and are now at 2015 levels. As a result, we saw Brent prices average nearly $61 per barrel, up 18% quarter on quarter. Gas prices didn't follow and were stuck at about $2.9 per million BTU in this quarter. Looking at India, we are clearly seeing an economic recovery. GDP has recovered to 6.3% in second quarter, and the industrial production data, which came out a few days ago, shows industrial production rebounding to a 2-year high. Important for us, we saw a 5.9% growth in demand for transportation fuels in the last quarter year on year, which is one of the stronger growth periods that we have seen. Air passenger traffic up well in double digits at 16% year on year. Gasoline demand up 6.8%, diesel demand up 4.6%, LPG demand up 6.2%. So every part of the refining product barrel saw strong growth. In Indian petrochemical demand, again up polymers 10% year on year, and polyester a bit more modest, but growth in the second half at 4% year on year. We are seeing in the near past a strong demand growth coming back as the markets have stabilized. Let me now spend a few minutes on our refining business. As I said, $11.6 per barrel and 12th consecutive quarter of double-digit refining margins. Slightly softer than last quarter, where we reported $12 per barrel as refining margin. We saw some softness in gasoline margins, 14.4 versus 16 in the previous quarter, as supplies resumed after the hurricane season in the US and a softer winter driving environment. Diesel cracks were also roughly $1 per barrel lower, simply because of exports in coming out of various Asian countries, including China. On the other hand, we had positive outcome coming out of strong naphtha cracks, among the strongest in recent times, and weaker fuel oil cracks, which helped us with the crude sourcing. We also saw slightly wider Arab light, Arab heavy differentials, which was good for complex refining. So all in all, still a very good quarter as far as refining was concerned. Our focus is now continuously on expanding our domestic network. We have 1,281 retail outlets. We are also increasing the throughput in each of these, which are between 40 to 80% higher than what we had a year ago. And we continue to look for opportunities to make bulk supplies to Indian consumers. In our petrochemical business, as I said, highest ever EBIT at 5,753 crores, up 73%. The production growth, 7% relative to previous quarter, came out on the back of MEG and polyethylene production. Polyester margins were very gratifying in this quarter, well above 5-year averages, and we saw margin expansion in both PSF, PET as well as POY. We are really seeing the markets better balanced, running on lower inventory, strong customer demand, which gives us the opportunity to see some margin expansion. MEG is another product that did exceptionally well in this quarter, where our additional volumes were placed at better margins. Similarly, in the polymer chain, we saw margin expansion in polypropylene, and polyethylene margins stayed flat on mixed feed cracking. Indian demand looking good, with the polymer demand up 10% year on year, in which polypropylene was the star performer at 15%. And as I said earlier, polyester demand has also begun to grow. With the completion of our projects in petrochemicals, we are now among the top 5 producers globally in each of those single products: paraxylene, PFY, PSF, PTA, polypropylene, and among the top 10 producers globally in virtually everything that we produce. We have, as I said earlier, the highest level of integration with the refinery, giving us unmatched flexibility. Moving on to upstream, this was really a flattish kind of a quarter as far as upstream is concerned. We saw volume decline coming out of natural decline in our domestic business, which was compensated by higher price realization on liquids and condensates. CBM production was slightly higher, and we are now producing just over 1 million cubic meters per day. As far as shale gas is concerned, we saw a good pickup in terms of unit realization, 22% year on year, and production was slightly down. So all in all, again, a flat performance. Let me talk about our consumer businesses now. We talked about retail a few minutes ago. Reliance Retail is the fastest growing retail business in the country. It's growing in every segment, in every format. We have over 3,700 stores. We have a retail footprint of 14.5 million square feet. AGO is gaining significant traction, over 50 million web visits in the last quarter. And we are making investments and expanding in every format. To give an example, Trends, where we sell apparel, we now have over 400 stores operational. We added 25 new stores in this quarter alone, and we had more than 25 million footfalls in our Trend stores during this quarter. Finally, let me talk about Jio once again. The first thing that I would like to say is that when we look at our subscriber base, it now has crossed 160 million. This is a net addition of about 22 million in this quarter, gross addition of about 28 million subscribers. It is by far India's largest wireless data subscriber base. Not only do we have a large base, we also have a high-quality subscriber base. Our churn ratio at 1.4% is the lowest in the industry.
Be the next crisis, in which country, in which sector, and when, and is there a risk of another global financial crisis, and over which horizon? And of course the next question, of course, is one about the global economic outlook. What's the outlook for the US, the global economy, for China, India, and emerging markets? What's the outlook for economic growth, for inflation, for economic policies, monetary, fiscal, and otherwise? And of course, what are the implications of that for a variety of asset prices like US and global equity, bond yields, currencies, commodities, and emerging markets? But more recently, actually, as I go around the world, the very first question being asked is the one, should I buy Bitcoin? And is Bitcoin a bubble or not? So we live in a world of uncertainty. We live in a world of risk, whether you are an economist, an academic like me, whether you are a policymaker, whether you are a businessman like many of you, whether you are an investor. You are facing a number of risk and uncertainty, and you have to make economic, investment, business, financial decisions that imply saying something about factors that are still about the future that are unpredictable. So the question is, in some sense, how you make sense of the future, how you predict the future, and how you manage a variety of risks that you have to face. And now, regarding forecasting and prediction, I'm always reminded of that famous saying by Yogi Berra, who was the New York Yankee coach, who said once famously, it's very hard to make forecasts, especially about the future. So that'd be the first observation. The second observation I'll make is that there is that joke that says that God created economists to make astrologers and weathermen look good when predicting the future compared to economists, given that economists had a dismal track record in predicting the most recent global financial crisis, a few exceptions like myself and others. And the final rule that usually people give you when you say make prediction is to say, if you make a prediction about an event that's going to happen in the future, like the next recession, then don't say when it's going to occur. Just say there's going to be a recession. You're going to be right. Or if you make a prediction that something's going to happen this year, say in 2018, don't say what's going to happen. So either give the event or give the time, but never give a time and an event, because you're going to be definitely wrong. So that's one way of becoming a more successful, essentially, forecaster. But being a little more serious about it, I would say that certainly one of the things that happened in the last few years has been that the frequency and the virulence of a variety of tail risk, like global financial crisis, banking, corporate, sovereign, household, and so on, has become more frequent, more virulent, and with more economic, fiscal, and financial costs than the past. So we cannot ignore this effect. Anybody among you might be investing in particular security, investing in particular firms or sectors, but you have to be aware of the macroeconomic risk, because even if you make the best investment in the best country, in the best sector, in the best firm, if, like in Argentina in 2001, there's going to be a currency crisis, a banking crisis, a sovereign debt crisis, a corporate debt crisis, a capital account crisis, then your investment is going to be wiped out, and therefore being aware of the macroeconomic risks that lead to risks to be on or off, that lead to significant correlation between different asset classes, an important thing that you have to keep in mind. So while you're making decisions on business investment bottom up, the macro view is very important as well. And in that context, when you think about tail risk, a risk of extreme economic policy, financial events like a financial crisis or major economic policies can radically change your outlook, positive or negatively, I'm led to think about a comparison I usually make with my good friend Nassim Taleb, that I understand was the keynote speaker last year. And when Nassim Taleb thinks about tail events, like tail risk or financial crisis, he calls them black swans. And what are black swans? Are essentially events that are in some dimension unpredictable, like black swan when it occurred. Nobody believed there was a black swan until in the 19th century one was found in Australia. So if you think about an event like a tornado or an earthquake, even with our scientific knowledge today, it's very hard to predict when an earthquake is going to occur and where it's going to occur. Same thing for a tornado. But when I think about this tail risk event, rather than black swans, and that's the title of the book of Nassim, the first chapter of my book, Crisis Economic, is called White Swan. And why it's called White Swan? Because I think of financial crisis as being a predictable event. They are the result of a build-up of economic, financial, policy, vulnerability and mistakes, like a build-up of excessive debt and leverage, of excessive risk-taking, that eventually reach a tipping point. That tipping point is the financial crisis. So they're more like a hurricane rather than a tornado or an earthquake, because as we know, the science of predicting hurricane tells us that the build-up of certain meteorological forces eventually leads to a hurricane occurring in a particular country or region at a particular point in time. So while predicting exactly when a financial crisis is going to occur is not so easy, financial crises are not random events like an earthquake or tornado that are totally unpredictable, but usually are the results of the fact that there is these vulnerabilities, whether policy, macroeconomic, financial, or otherwise, that eventually reach what economists refer as a Minsky moment, a point where the boom and the bubble ends up into a bust and a crash. And therefore, economic analysis, financial analysis, and a variety of tools can help us to understand when they happen and why they happen. So in that sense, there are white swan events as opposed to the kind of a black swan events that Nassim Taleb refers to. Now, if I have to be a little more specific, of course, one of the interesting things that is in the mind of everybody today is what's the outlook for the US and the global economy, both advanced economies and major emerging markets like China, India, and other ones, both in terms of economic growth outlook, inflation, outlook for monetary fiscal policy, and of course for asset prices and financial market. So how is the global economy doing? Is it doing well or is it not doing so well? Now, in answering this question, I'm reminded of that story that happened about 20 years ago when John Major, who was then the Prime Minister of the United Kingdom, went to Moscow in the late years of the Soviet Union, where the Secretary General of the party was Gorbachev, before the collapse of the Soviet Union. So he meets with Gorbachev and he says, Secretary General, can you tell me in brief what is the state of the Soviet economy? And Gorbachev looks at him dourly and he says, good. Major is a little perplexed and he says, maybe can you elaborate a little bit more in a few words? So Gorbachev looks at him again and he says again dourly, not good. So when I think about the global economy, in one word I would say things are good today. If I have to say it in two words, I would say not good. And why I say so? I say so because while there are many actually upsides to the global economy today, and I'm going to discuss them both in the short term and the medium term, there is plenty also of downside risk and vulnerabilities. And of course, whether these vulnerabilities are going to materialize or not is going to depend on important decisions that both the private sector and the public sector has to do. But the reality is that the world is complex, that things can go in a positive direction, and for the last year or so have gone in a positive direction, but there are also a variety of tail risks that can disrupt the global economy and financial markets. So I think a fair assessment will consider both the positive and the upside, and some of the negatives at the same time. So let me start with the positive, and I'm going to start with the short term, and then I'm going to talk about some of the more medium and long-term trends in the global economy, what can go right and what can go wrong. In many dimensions today, the world economic outlook is quite positive. The good news is that we are in a period of a global economic expansion that economists define as positive growth that is accelerating, as opposed to a period of a global economic slowdown where growth is positive but decelerating. And if you look at the last couple of years, we've been in a yo-yo where the global economy has gone from a global expansion to a global slowdown, not a recession, but a slowdown. And the two periods of slowdown that occurred in the last 2 years were associated with periods of risk-off, where people worried about tail risk in the global economy. One risk-off episode was August and September of 2015, when people worried about a Chinese hard landing, and the second episode occurred in January and February of 2016, when in addition to renewed concern about the Chinese hard landing, there were also worries about U.S. economic growth stalling. The Fed had just announced they would start moving away from zero policy rates and hike, they claimed 4 times in 2016. Oil prices and commodity prices were collapsing, hurting emerging markets that were commodity exporters, and the worries about Brexit and Grexit and you name it. So it was like a mini perfect storm for a couple of months, where US and global equity corrected by over 10% in January, February of 16, and another similar correction occurred in August, September of 2015. And those 2 episodes of risk-off were associated with a global economic slowdown, where suddenly the risk-off led to less production, less investment, and a slowdown of global economic growth. Now, the good news is that even before the election in the United States of Donald Trump about a year ago, when the reflation trade started to pick up in the United States, the global economy started to accelerate already in the summer of 2016, about 6 months before the election of Donald Trump. After the Brexit vote, there was a little bit of volatility, but then there was a pickup of global economic growth, and that momentum in global economic growth has occurred more robustly in the last year and a half. US growth is accelerating. The European and Eurozone growth is accelerating, with the exception of the UK, where they got Brexit. In Japan, Canada, and other advanced economies also accelerating. And emerging markets that had 3 difficult years between 2013 and 15. These were difficult years because during those years you had the taper tantrum, you had the slowdown of China, and the end of the commodity super cycle, and there was a sharp slowdown of growth between 13 and 15 in most emerging markets, and also a correction downwards of commodity and equity prices. Since 2016, there's been a significant acceleration of growth in most emerging markets, with few exceptions. Even the countries that had an outright recession, like Brazil and Russia, are getting out of that recession. China, where there were worries about a hard landing, now has accelerated its growth rate. Things have been bumpy for a few quarters because of the short-term impacts of demonetization and the GST introduction in India, but even in India, last couple of quarters suggest an acceleration of growth. So whether it's advanced economies or emerging market, there is a pickup of global economic growth, and that's positive, first observation. A second observation is positive, is that in advanced economies last year, in spite of that pickup of growth, inflation remained low, and actually in the US, core inflation fell. That's a bit of a puzzle, because you would expect that with a stronger growth there is less slack in goods and labor market, you are close to full employment, and some acceleration of wages and prices will occur. And instead, not only in Japan and Europe, where inflation is low for many reasons, but even in the US, inflation was falling while growth was accelerating. The Fed was explaining it as a result of a bunch of temporary positive supply shocks, with the emphasis on the temporary, but you have this paradox: stronger growth, lower inflation. But one of the implications of having stronger growth and lower inflation was that made life easier for central banks. And not just the ECB or the BOJ that are continuing with unconventional monetary policy, given that their inflation is still very low, but even the United States, the Fed, the exit from unconventional monetary policy was very gradual. Yes, last year the Fed hiked several times, but financial condition eased rather than tightened. Long rates went lower, the dollar went lower, and the stock market went higher. So you lived in a bit of a Goldilocks world, where growth is stronger, inflation is lower rather than higher, central banks are still following very accommodative monetary policy, and the consequences of these 3 factors is that risk is on rather than being off, animal spirits of investors are positive rather than negative, and also business and consumer confidence is stronger, and volatility remains low in most risky assets, in part because growth is picking up, inflation is low, and central banks are still doing monetary accommodation, and therefore the price of a variety of risky assets, US and global equities, but also credit, commodities, emerging market assets, and so on, is going higher and reaching new highs. So there has been a massive amount of asset reflation, both in advanced economies and now in emerging markets. And that asset inflation implies positive wealth effects, better business, consumer, investor confidence that feeds into the real economy, leading to a virtuous cycle of stronger asset prices and stronger economic growth. So in some sense, this is a Goldilocks situation where things are just right and almost perfect. For the first time, because as we know, after the global financial crisis, the recovery was mediocre, anemic, subpar, with growth below potential, and for a while potential growth both in advanced economies and emerging markets was falling, to the point in which the IMF 2 years ago was talking about the global economy being stuck in a new mediocre of low actual and potential growth. So this is a positive feedback, and actually since U.S. risky assets seems to be slightly overvalued, a lot of money now is going to other advanced economies like Europe, like Japan, but a lot of money is flowing back also to emerging markets that had 3 difficult years until 2015, and that there's a recovery of equity prices in emerging markets and a recovery of other important things like energy and commodity prices that are positive for those emerging markets that are, of course, commodity exporters. Of course, there are caveats. In a case like India, where you are a net oil and energy importer, the rise in oil prices is a negative rather than being a positive. Now, the question mark, of course, is that this outlook in 2017 can continue in 2018, and most of the consensus says this year is going to be another positive growth for the global economy, even slightly better than last year, and the consensus says inflation is going to rise in advanced economies, but only gradually. Therefore, the Fed is going to exit policy rates and normalize them gradually. Therefore, the increase in long-term interest rates is going to be gradual, and therefore we're going to have another year where risky assets like U.S. and global equity are going to do well. Maybe not as well as they did last year, where equity prices went up in the U.S. 20% and so much in other advanced economies and emerging markets, but it could be another positive year for a variety of risky assets. And certainly that positive baseline could be what it materializes. The question that as a businessman, as an investor, you have to ask yourself is what could go wrong compared to this positive scenario? What are the potential tail risks? Now, both on the upside and the downside. Now, one of the paradoxical observations I'd like to make tonight is that paradoxically, if the global economy were to grow even better than the consensus is forecasting right now, that positive news about global economic growth might actually become negative, because it might lead to an acceleration of inflation that's going to be actually negative for asset prices. And the argument is as follows. The consensus is expecting today that global growth this year is going to be slightly better than last year, say 3.7% globally rather than 3.6%, and of course emerging markets are going to grow 5% plus, while advanced economies are going to grow around 2% or less. However, until now inflation has been low, but in a number of advanced economies and emerging markets we're clearly close to full employment. The slack in labor market is very low, with unemployment rate in the U.S. below 4%. The slack in the goods market is low, as the output gap has been reduced, and low investment implies there is not much excess capacity in a number of economies, not everywhere. And therefore, what's the risk that there is going to be a significant acceleration of growth? In the United States, the fiscal stimulus coming from a large tax cuts implies that on top of any global economic recovery, the tax cuts may further stimulate economic growth by increasing disposable income. And suppose that this acceleration of growth becomes excessive, suppose the economy overheats, and because of the tightness in the labor market, we see a sudden and surprising increase in wage inflation and goods inflation, and with oil and commodity prices sharply up, headline inflation could go also higher because of the rising price in oil, energy, and commodity. And suppose that happens, and suppose that increase in inflation because of too much good news on the growth side, it takes the Fed by surprise, because the Fed is now expecting the U.S. a gradual increase in inflation. And the Fed is expecting to hike rates only 3 times, 75 basis points total this year, and only 2 times next year. But suppose the acceleration leads to inflation to be much higher, then this year the Fed has to hike not 3 times, but maybe 4, while the market today is pricing in only 2 hikes. And next year, the Fed might hike 3 times, if not 4, where the Fed until now has said we're going to hike only 2 times, and the market is expecting only 1 hike by the Fed next year. Then short-term interest rates are going to go much higher. Long-term interest rates are going to go much higher, and instead of a taper tantrum like in 2013, you might actually have a rate tantrum, and that sharp increase in long-term interest rates is going to be negative for U.S. growth, is going to be negative for interest rate-sensitive sectors like capex and real estate, is going to lead to a strengthening of the dollar, is going to lead to a weakening of the jobs creation and production in the manufacturing sector. And that, through trade and financial channel, is going to be a meaningful shock, not just for the United States, but also for emerging markets, where a sharp and unexpected rise in U.S. policy rates and long-term interest rates is going to be a negative shock. Financially, it might have an impact also on economic growth. So paradoxically, the worst scenario that could actually derail the global economic recovery is when growth accelerates so much and overheating occurs in the U.S. and other advanced economies to the point in which there is a significant surprise acceleration in U.S. and global inflation. Because if there is one risk that currently long-term interest rates and bond markets are not pricing in, is the risk of having a significant increase in inflation that leads to much higher long-term interest rates. And we know that one of the reasons why many asset prices have been high, because today no asset price is cheap. U.S. and global equities are expensive, private equity is expensive, credit is expensive, government bonds are expensive, real estate is expensive. EM used to be cheap until 15, but now is not cheap anymore. Commodity used to be cheap, but they're not cheap any longer. So pretty much every asset class in the world is expensive, and what is keeping this valuation high is very low interest rates on the short end and the long end of the yield curve, starting with the United States. If an inflation shock were to occur, that will be what is derailing the rally in the markets and what also is going to derail the rally in global economic growth. So too much of a good news on growth that leads to inflation might be actually the biggest shock that leads to a shock to asset prices and a stall in economic growth, U.S. and globally. So that's the one tail risk that one has to keep in mind. Of course, in a baseline scenario, growth is going to pick up, inflation is going to go higher gradually, the Fed is not going to hike more than 2-3 times, long-term interest rates in the U.S. are going to go higher, but only gradually, and the market is already pricing in that one, and therefore both emerging market and financial market can absorb a gradual increase in U.S. short-term and long-term interest rates, and it's not going to be severe, it's going to be a soft landing, that type of adjustment. But if it occurs very suddenly, then that's going to be a risk that one has to keep in mind. A second thing that you have to keep in mind in terms of global risk are those coming from China. Everybody agrees, including the Chinese, that Chinese growth model is unbalanced. There has been a massive increase in debt and leverage. There is a massive amount of overcapacity. There are bad assets and bad debts. And every time China had a slowdown and a concern about hard landing, the way they avoided that hard landing has been to do another round of credit-fueled fixed investment. That means more capex, more real estate investment, more infrastructure, and a build-up of greater amount of financial vulnerabilities, of leverage and overcapacity. Now, this year, of course, was the year of the party congress, and during a political year like this one, stability and growth were trumping the objective of restructuring, rebalancing, reducing debt and leverage. However, now the party congress is over. President Xi Jinping has all the power in the world, and therefore China has to accelerate the much-delayed reform, structural reform, supply-side reform, cleaning up SOEs, cleaning up the banks, reducing excess capacity, reducing debt and leverage, reducing credit growth. If China were to implement now faster these policies, then the landing of China is going to be softer, but there's a risk that China keeps on saying, hey, we can maintain growth at 6.5 because that's our political objective, even if potential growth is probably closer to 5%, and the only way to keep growth at 6.5 is to do new rounds of fiscal stimulus, of credit fuel, fixed investment is going to increase economic, financial imbalances, and eventually, not this year, but in a matter of 2 years, could lead to a harder landing of China. So I would say the economic problems, the financial problems of China have not been fully addressed. They've kicked the can down the road. They had to do so because there was a party congress, but now is the time of action. So looking carefully at what China is going to do is going to be important. Now, for the last few years, Europe and the Eurozone has been a source of global tail risk. There are even worries that there will be a disintegration of the European Union following the Brexit vote of the UK, or disintegration of the Eurozone, where there was a risk of a Grexit, of a Greek exit from the Eurozone that might lead to a domino effect with other countries exiting. The good news out of the Eurozone is that many of the risks have been reduced. Growth is stronger. Inflation, or the risk of deflation, is gone. Fiscal balances have been improving. The banks have been recapitalized and the financial risks are limited. And the risk of outright breakup of the Eurozone is low. Even a basket case like Greece now has stayed in the Eurozone, is doing fiscal austerity and reform. So Eurozone for once is not a source of tail risk. But there are still problems that can occur in the Eurozone. There is a rise of extremist populist party of the right and the left. And none of them has come to power yet in parts of Europe, but the risk is that they could over time. The risks are in Italy, the risks are in Spain, the risks are in Greece still, and there is greater amount of political instability in Germany. Is a core part of Europe. And the process of monetary integration is still incomplete. You don't have a full monetary union, you don't have a full banking union, you don't have full fiscal union, you don't have a full capital markets union, you don't have full political union. And however, gradually, to make the Eurozone successful, greater Eurozone integration might have to occur, however gradually, but that process of integration is stalled. So I would say the tail risks coming out of Europe are limited compared to the past, but they're there. There are two other couple of important things that can happen globally that are tail risks to keep in mind. One is that these unconventional monetary policy have led to asset reflation, but the risk is that asset reflation eventually becomes asset inflation, and asset bubbles become credit bubbles, and if that were to occur further, eventually a repeat of the global financial crisis could occur. Now, my view is that after 10 years of painful in the US, then in Europe, and now in emerging markets, the beginning of a releveraging in the corporate sector in the US and some emerging markets, of releveraging not of the banking system that has more capital and more liquidity today and less leverage, but of the unregulated shadow banking system in the US, in China and other parts of the world. That process of releveraging is ongoing. We're not, by using another baseball term, in the 8th or 9th inning of that credit releveraging cycle, like we were in 2006, 2007, we're maybe in the 4th or the 5th inning. But it's also true that if this excessive releveraging of many parts of the financial system and the corporate sector were to continue for another 2 or 3 years, and we know that we're already living in a world where private and public debt in advanced economies and emerging markets are already high, and if they were to become higher, and what keeps sustainability today still strong is that while debt ratios are high, debt servicing ratios are low, and debt servicing ratios are low because interest rates on the short end and the long end of the yield curve are low, but they're going to rise gradually over time. So if debt ratio and deficits are going to rise, and interest rates are going to rise eventually, gradually, then the risk of eventually this ending up in tears down the line, 2, 3 years down the line, is a risk that has to be considered, and that's why it's very important to maintain prudential regulation and supervision of the financial system, of the corporate sector, of the non-bank financial institution, especially of the shadow banking system. And that's one thing to keep in mind. Final thing that is interesting is that today there is a wide range of rising geopolitical risk. There is a risk of a war between the US and North Korea. There is this looming decade-long war between Shia Iran and Saudi Arabia. It's a proxy war that is being fought not directly between them, but in Syria, in Iraq, in Lebanon, in Yemen, in Libya. that could lead to a oil supply shock like the one that occurred in 1973 or 1979 or 1990. There are other global geopolitical tensions, and at the domestic level, as we know, there is this populist backlash against globalization, against trade, against migration, against supranational authorities. You have seen it with the Brexit vote, you have seen it with the election of Donald Trump, you have seen it with extreme populist parties of the extreme right and left becoming more popular, not just in Europe, but also in some emerging markets. But for whatever reason, financial markets are discounting this risk. There is almost no pricing in of a war between the US and North Korea, or the fact that there could be a major supply-side shock to oil prices coming from the Middle East. Now, one explanation of that is that markets are rational, that the risk of a major supply shock or a major war between major countries is still low, and therefore this is a tail risk, but there's a very low probability. Second interpretation is that even if a shock like this were to occur, central banks are going to come to the rescue of the market, because in the last few years, every time there is a tail risk, central bank do monetary more easing, the Fed, the BOJ, the ECB, the PBOC, and so on. So even if a shock were to occur, central banks are going to react in a way of reducing those tail risks. But there is also a possibility that markets are mispricing this political risk, and that some of them are going to materialize. They're going to have a material impact on the global economy and financial markets, and markets are underestimating the probability of something of that sort from happening. So that's one thing to keep in mind. So these are some of the short-term risks. I would like to discuss also what are the medium, long-term prospects for the global economy, why you can be positive about it, but also what are some of the potential tail risks that one has to keep in mind. On the positive side, I will make the following observation, leaving aside the short-term noise. First positive is that, yes, we had the global financial crisis, and this great recession of 2008-09 could have ended up into another Great Depression, but thanks to the policy reaction of central banks, fiscal authority, and others, this is a Great Depression 2.0 did not occur. And since 2009, there has been a global economic recovery, and that recovery is now accelerating. So that's one positive. We could end up like in the 30s. That did not happen. Secondly, if you look at the balance sheets and the P&Ls of the corporate sector in advanced economies and emerging markets, with few exceptions, the balance sheets and P&Ls of the corporate sector are quite sound. And again, there are some exceptions in many parts of the world, but that means that these corporates in the private sector have the financial resources to do more job hiring, more capex, more production, more M&A activity, more domestic and foreign direct investment, and as the global economic outlook is improving, as business investor confidence is rising, there could be a significant pickup of animal spirit that leads to greater investment, greater production, greater job creation, and that's going to be a positive for a further acceleration of global growth. Third positive, medium term, is the rise of emerging markets. Emerging markets are already today at least 50% of global GDP, and at least 2/3 to 3/4 of global growth, given that the potential growth in emerging markets is about 5%, while the potential growth in advanced economies is between 1% to 2%. And therefore, over the next few decades, even if that differential between 5 and 2 remains, a greater share of global GDP and a greater share of global growth is going to come from emerging markets. And these countries are industrializing, they are urbanizing, there is the greater demand for consumer durables, for housing, for transportation, for a variety of goods and services, and as long as this 5% average growth in some countries like India and China can grow much faster than 5%, is going to continue, that means that you'll have multiple engines of global growth, not anymore just US and Europe, but China, India, and other emerging markets are going to be key players in global growth. And that's going to be a positive for the global economy. Additionally, if we're going to look at the medium-long term, there are some trends that are very, very positive. We tend to forget in the daily noise of economic activity that there are many things that have changed in the last few decades for the better. Because of biotechnologies, we have now a situation in which life expectancy in advanced economies and emerging markets is much longer than before, and the overall health of individuals is also better. So we all gonna live longer and gonna live longer and healthier. That's a major revolution compared to the past where people were dying young of many diseases. In most parts of the world, we've also conquered hunger and starvation. Episodes of famines and major dramas of this sort tend to be these days an exception rather than being the rule like they used to be in many poor countries a few decades ago. And in spite of all geopolitical risk, today there is no major war or risk of a major war between major countries in the world, and that's also a positive compared to the past. There is an Israeli historian who wrote a book about the history of humanity, and he said that today there is a revolution because more people die of suicide than they are killed in war or terrorism for the first time ever. More people die of obesity than hunger, famine, and starvation, and more people die of old age than from infectious disease or plagues. And this is a total change because for the last 3,000 years of human history, people died of plagues, of infectious diseases, of famine, of war, and so on. And this is a radical shift that we should not be underestimating. There's a radical change that has improved the lives of billions of people, especially in emerging markets. The final positive thing about the global economy, I would say, is that there is a massive amount of technological innovation. And there is a wide range of new industries of the future that are going to be completely changing the way we live, the way we work, the way we play, the way we entertain, the way we socialize. What are these new industries of the future? One of them, I would refer them as ET, as energy technologies, is new forms, for example, of fossil fuels like shale gas and oil, not just in the US, but in many parts of the world, but is also the entire space of alternative energy, of green economy, of clean tech, of solar, wind power,